Hi, welcome back to the second part of what it takes to be a profitable trader. I'm Adam Khoo. In the previous lesson, we learned the first two factors. Number one is you got to have a trading system that suits you, and you got to size your positions consistently. And together, it will give you a positive expectancy in your trading method. So, what does this mean? This means that over time, the more you trade, the more money you are sure to make. It's kind of like a casino. A casino knows that in the short term, they could make or lose money. But in the long term, the casino always wins. They always win. The house always wins. So you have to do the same thing as a professional trader so that it's a reliable source of income. See, many people I know, they trade a system that doesn't have a positive expectancy. So even if they make a lot of money in the short term, it's down to luck. And once their luck runs out, the more they trade, the more they lose. Whatever they made, they lose it back to the market. So you do not want that. You want a long-term profitability. So how do you know if your system has a positive expectancy or a statistical edge in the market? Well, you got to use this formula. And the formula goes this way. Your expected profit per trade equals to percentage win multiplied by average win minus percentage loss multiplied by your average loss. So let's put in some numbers over here. Now recall from the last lesson, you learned the meaning of 1R. R represents your percentage risk per trade. So whenever you take a trade, you always risk the same percentage of your capital, which can be anywhere from 1% to 3% risk, but it's got to be consistent. So if you have a losing trade, you would lose 1R or 1% of your capital. If you have a winning trade, you would win at least 2R or 2% of your capital would gain. Make sense? Great. So using an example of a trading system which I showed you earlier on in the previous video, and you start with a capital of $10,000 for example. And in the trading system I taught you, your average loss is 1R. It's always 1R, remember that, because of the stop loss. It hits the stop loss, you lose 1%. And we place our profit target at double our stop loss distance. So your average win is always 2R. So remember, there are only two outcomes. You either lose 1R or you make 2R. Simple as that. That's a trading system. So if you put it in the formula, what do you get? Your percentage win. Now, what's the percentage of winning trades? Like I said, for most trading systems, you can expect an average win of 50 to 60% win rate. So to be conservative, let's take a 55% win rate. So you're going to win 55% of the time and lose 45% of the time. Now, when you win, you will win 2R. And when you lose 1R. Again, what is R? R represents your percentage risk of your capital. So if you put in the numbers, this would give you 1.1R minus 0.45R. That gives you 0.65R. Now, question, is this positive? Yes. As long as your expected profit per trade is positive, you are guaranteed that the more you trade, the more money you will make. Remember, in the short term, when you trade, you could win 2R or you may lose 1R. But because you are winning an average of more than what you're losing, you will have a net gain of 0.65R per trade on average. So what does this mean? This means that if you do an average of 20 trades a month, which is pretty common, 20 multiplied by 0.65 gives you 13R a month. So on average, for every 20 trades you make, you should make 13R in profit. So again, what does 13R mean? R is your risk per trade. So if you are risking 1% per trade and you get a 13R result for the month, that's a 13% return on your capital. Okay? So if you can do a 13% return on average a month, and you do that for a year, that's over 160% return. You more than double your capital in a year. On the other hand, if you risk 2% on every trade, which means your 1R is 2%, a 13R return would represent a 26% return a month. So if you're getting a 26% return a month, and you do that for a year, that's more than 350% return a year. Now, you do not have to have necessarily a high win rate to have a positive expectancy. A good example is that of legendary trader Richard Dennis. And some of you may have heard of Richard Dennis. He's the guy who developed the turtle trading system. And Richard Dennis is well known for turning about $15,000 when he started into over $200 million in profits. And when you read about Richard Dennis, you find that his average win rate was just about 25 to 35%. So how did he have a low win rate but still manage to make so much money? Because again, it's not just the win rate, but it's the risk to return ratio. And one style of trading which I showed you earlier on would be, for example, when you place a buy order over here and a stop loss over here, and you exit somewhere over here. So you're risking 1R to make 2R. So we call that a swing trade. Now, some traders, they do not like to exit at 2R. They would prefer to hold the stock and ride the trend as far as the trend will last. So because of that, they may get a 5R win or even a 10R win at times. Or they may have a higher target price. Now, there's always a trade-off, because the higher your target price, the longer you stay in the trend, the higher the chance it may reverse and you may end up with a loss. So, but even then, you can still have a system with a positive expectancy. Let me give you an example of how someone like Richard Dennis would trade. So, for example, his loss would be also 1R, because he would risk 1% or 3% of his capital. But his average win would be 6R, because he holds the trade for a longer time. He rides the trend and only exits when the trend ends. But again, because of that, it may affect your win rate to be lower. So what happens if you have a win rate of 25%? So in other words, out of 100 trades, you win 25 trades and you lose 75 trades. But each time you win 6R. And you lose 1R. So if you calculate the expected profit, you still get 0.75R per trade, which is still positive. So you can see in this case, even though the win rate is lower, but because the risk to return ratio is higher, you still end up with a positive R per trade, which is a positive expectancy system, which means again, the more you trade, the more money you're going to make. So again, in other words, for every 20 trades, you should expect to make 15R return a month. If you risk 1%, that's 15% return a month. If you risk 2%, that's 30% return a month. If you risk 3%, well, you can do the math, right? Now, on the other hand, you can have a very high win rate, but have a very low expectancy in your trading system. In the newspapers, I often read of some forex traders who say that their win rate is 90%. They've got this 90% strategy, right? And sure, I mean, it's 90%. But even then it's 90%, but they may have a low expectancy. Let me explain why. For example, I know a trader where what he does is, for example, when he goes long on a currency pair, Euro USD or some forex pairs, what happens is he will enter the trade at a certain price. And he would have a stop loss which is very far away, for example, 100 pips away from the entry price. 100 pips, right? And his target price would be only 15 to 20 pips. So what happens when you have a very big stop loss and a very small target price? Well, what happens is you will have a very high win rate. So sure enough, you may get a win rate of 90% because you can hit the target price very easily, and you'll take a lot longer or more difficult to hit the stop loss. But what happens if you do it this way? Let's take a look. So in this case, when you lose 1R. And remember, 1R is 100 pips. And when you win 20 pips, which is only 0.2R. So if you put it into the formula, what do you find? You find that sure, you have a win rate of 90%, but 90% of the time, you will win 0.2R. And 10% of the time, you would lose 1R. So if you do the math, you find that your expected profit is only 0.08R, although it's positive, but it's very low. And this means that on average, if you do 20 trades a month and you get 0.08R, 0.08R per trade, your expected profit per month is only 1.6R per month, which means if you risk 1% of your capital, you're only making 1.6% return a month, which is quite sad, right? So in other words, you have to risk a big percentage of your capital, say 3%, in order to get a reasonable return, right? If you risk 3%, for example, and you get 1.6R, that's a 4.8% return on your capital. So you can see that a system with a 25% win rate can get much better results than a system with a 90% win rate. So in judging your trading system, you don't just look at the win rate, you look at your risk to return ratio and your trade frequency as well. And it's got to lead to a positive return per trade. So to summarize, what determines the profitability of your trading system? Well, the first thing is your win-loss ratio, right? But that's not good enough. It's your average win to average loss ratio and the frequency of your trade setups. Now this chart is, we've got to credit it to the chartist by Nick Rage, a fantastic trader. And he has created this chart to show you that, for example, if you have a trading system with a win rate of 60%, in this case, 60% win rate, and if you get a win-loss ratio of 1:2, you are very profitable. In fact, at a 60% win rate, even if, or rather, if you risk 1:2, even if your win rate is 50%, you are very profitable, right? So a good trading system should have an expected profit per trade of at least 0.5R to 1R per trade and generate at least 20 setups a month. That makes a good trading system. So in Wealth Academy and in the traders which I coach to be professional traders, we always ensure that our trading system has a high expected profit per trade. Okay, so if you got a trading system that works for you, you got a position sizing which works for you, you have a positive expectancy. But you know what? That only makes up 40% of your success as a trader. And that is the reason why there's some people, they go for training programs or they buy trading books and they may learn the right trading system from the right professional trader. They may have the right money management system, but they still can't make money. Why? Because the majority of your success, of your ability to produce consistent profits, which is 60% of your success, comes from, yes, you got it, your psychology. See, psychology refers to your psychological discipline to follow the trading system consistently with no deviation. And that's one of the most difficult things that people are not able to do unless they have the right mental training or the right mental skills. So let me give you a metaphor. Let me give you an example of what I mean, right? So if I were to ask you to walk on a plank like that, which is say 3 or 4 inches wide, and I teach you how to walk on the plank, right? You put one foot forward, next foot forward, and use your arms to balance. Pretty simple stuff, okay? Now I put the plank on the floor. Could you walk across? Sure, you can follow the rules to a T completely easily. If I put that plank 3 feet above the ground, could you follow that system of putting one foot in front and the next foot next? Sure you can. But if I put that plank 20 stories high with cars below, guess what? Most people will freak out, right? They will not be able to follow that system. The same thing happens in trading. Because to many people, money is a very emotional thing, right? So the moment money is at stake in their account, and they see it going up and down, they freak out, and that's when they abandon the system. So it takes tremendous psychological and emotional mastery to follow a trading system. And for the majority of people, it's extremely difficult if they don't have the right mental training, if they don't have the right mental skills. Why? Especially when the trading system goes through inevitable losing streaks, or we call them drawdowns. Because again, no matter how good a system is, it will go through a losing streak. And that's the reason why, again, many people learn trading systems but are not able to replicate the profits of the winning trader. And that's one of the reasons why when I train professional traders, I spend most of my time training them in mental skills, emotional mastery skills, using neuro-linguistic programming to reprogram their emotions and their subconscious mind so they can execute the same trading system like a winning trader. So let me use my trading simulator to illustrate my point. So an example of a trading system I taught you would have a win rate of 55%, right? So in my trading simulator, what I'm going to do is I'm going to key in a win rate of 55% over here, okay? And it's a 1 to 2 risk to return ratio. So when we lose on a losing trade, we lose 1R. And when we win, we win 2R. Okay, so notice that every time I put in a winning rate here, I have a simulated winning rate. So every time I key in 55%, notice that I get a different amount each time because, oops, so sometimes it's more than 55%, and sometimes it's even more than 55%, and sometimes it is less than 55%. Why? Because it's a random number generator. It's kind of like life, right? If you toss a coin, the theoretical win rate of a heads is 50%. But if you toss it 100 times, you don't always get 50 heads and 50 tails. No, sometimes you may get 60 heads and 40 tails, or 40 tails and 60 heads. So in the short run, there's a bit of randomness in the situation, there's a bit of luck in the situation. But in the long run, if you toss the coin enough times, you always get a 50-50 probability. Now let's assume that you risk 2% on every trade. And let's assume you start with $10,000. There you go. So you can see that if you start with $10,000 and you get a 55% win rate, which in this case drops to 50%, and you are risking 1R to make 2R, which means you're risking, so 1R is 2%. So in other words, every time you lose 2%, as you can see over here. Right, you lose 2%. And when you have a, over here. When you have a losing trade, you lose 2%. And when you have a winning trade, you win double of that. So you win 4%. So this is a simulation over 100 trades, as you can see. So if you do somewhere about 20 trades a month, roughly in about 5 months, you can complete 100 trades. Okay? So you can see that based on this trading system, you can expect to get 159% return on your capital in 5 months over 100 trades, which means from $10,000, your capital will grow to $25,000. Now, would you like to have that? And most people will say, yes, I would like that. Now, I can guarantee you that you will get this result, or roughly this result, if you follow the system. But I can tell you that most people, psychologically and emotionally, they will not be able to follow the system. Why? Because you can see that out of the 100 trades, the wins and losses can come in a row. For example, you can see it's a win, it's a loss, it's a win, it's a loss, it's a win, it's a loss. Now, there will be a situation, if I can scroll down over here, where you get, over here, for example, a series of losses in a row. In fact, 1, 2, 3, 4, 5, 6 losses in a row, right? But at the same time, you will eventually get 6 wins in a row. And over here, you can see again, 1, 2, 3, 4, 5. 5 losses in a row. So What happens to most people when they get 5 or 6 or 7 losses in a row? That's right, they freak out, they get upset, right? And that's when they start to intervene in the trading system. They begin to remove their stop loss. They begin to take profits early. They begin to abandon the trading system and they use another trading system. And that's how most people will never become successful as traders, because of their inability to manage their emotions in following the trading system. The professional trader's mindset. And when do people really make the transition from a struggling trader to a winning trader? Well, it's when they have a realization. And the most profitable realization to a trader is when they begin to view each occurrence in their trading, which means each trade outcome, as a random series of events. In other words, when you have a winning trade, it's a random event. When you get a losing trade, it's a random event. You can't predict when the winners will come and when the losers will come. It is only the outcome over a larger statistical set, which means over 50 to 100 trades, that results in consistent and predictable profits. So at the micro level, in other words, on a trade by trade level, the outcome is random and unpredictable. But at the macro level, in other words, over 50 to 100 trades, the outcome is predictable when you have a statistical edge. So we are back to trading like a casino. The casino knows that at the end of the year, they will always make money. But when the casino plays with the player, they have no idea which hand will win and which hand will lose. But they keep following the system because in the end, they always make money. So how do winning and losing traders respond differently to losing streaks? Remember, it's not what happens, it's how you choose to respond to it. So when we go through a losing streak of losses, which will happen, you can see from the simulator, right? What do losing traders do? Well, they lose confidence. First, they lose confidence in the system. They say, oh, this system doesn't work. I should trade forex instead of stocks or trade options instead. And, they change their instruments. Or they say, something's wrong with me. I've got bad luck. And they start to think, I hate losses. How can I avoid losses? Now, struggling traders want to avoid losses. Winning traders accept losses as being part of the game. It's the cost of doing business. So what do losing traders do? By attempting to avoid losses, they do the following. Well, some of them, after they have a series of losses, they may start to overtrade. They start to take trades that are not in the trading system. Or they start to increase their risk in order to make up for the losses. And more often than not, that will lead to an even bigger disaster. A lot of losing traders, they tend to jump from one strategy to another strategy, right? So for example, they start with a trend following system. And when it goes through losses, they say, okay, let me jump to another system called mean reversion. It goes through losses, okay, let me jump to a forex system. Makes losses, let's jump to a stock trading system. And they keep going around in circles looking for that holy grail system, and they never find it. They always go around in circles and they always end up losing money. Some losing traders, once they go through a series of losses, they lose confidence to the extent where they avoid taking trades. And the moment you stop taking trades, you start losing money. Or they may reduce their risk per trade, or they start to add in new indicators, looking for the holy grail indicator that will help them to win all the time. Or they may start taking small profits and removing their stop losses. And any of these things you do will guarantee a disaster in your trading results. So what do winning traders do instead? Winning traders, when they go through losing streaks, they accept that it's part of the game. And they have confidence in their trading system's positive expectancy. So as a result, they can keep executing valid trade setups consistently. And remember guys, you can only reap the profitable rewards of a trading strategy's statistical edge by executing your trades as consistently as possible. So to summarize, what makes a profitable trader? Number one, you gotta have a good trading system that fits your personality. Number two, you gotta size your positions accordingly and statistically. And number three, you have to have a winning trader's mindset to follow your system. If you have all these three elements, you will be a profitable trader. And I hope I've shared with you something useful in this video. And if you've got questions, you can send me an email or drop me a comment on YouTube. I'll be happy to help out. If you want more videos, do subscribe to this channel. This is Adam Khoo. Take care and happy trading.